this is Brandy. Thank you for your patience. Our YouTube feed has started. Today is Thursday, April 29th. It is 9 minutes after 10, and we are starting our Deferred Compensation Advisory Committee meeting for San Joaquin County. Donna, will you take the roll call?
Yes, I will. Okay, Brandy Hopkins.
Here.
Jay Wilberding.
Here.
Christine Babb.
Here.
Nancy Calkins.
Here.
Ponce Kilcom.
Here.
And Catherine Miller.
Here.
Thank you.
Thank you, everybody. Our first agenda item this morning is approval of the minutes for two quarterly meetings, or
Brandy?
quarter meetings.
I'm sorry to interrupt. This is Jason. I see that Jeffrey Waltkamp is in attendance, and I believe it would be appropriate for him to be a voting member as the assistant in charge of the Auditor Controller's office at the moment. Unless there's any objections, I would recommend adding him to the role and voting on any items.
Okay, thank you, Jason.
Okay,
I'm here.
Thank you.
Welcome aboard, sir.
Thank you.
Now we'll go to approval of the minutes for one quarterly meeting of February 4th, 2021, and the special meeting that was held on March 18th, 2021.
This is Fonse. I have a question.
Yes, Fonse?
Really quick, this is probably for Jason. I know that you were just talking about voting members. And I know that during the last meeting, we voted on the extension. It's my understanding, again, we're an advisory committee. Isn't it still under Brandy's, the HR director's prerogative to do whatever she wants, but basically we just advise her? How does that work? Or are we actually voting as a committee and then actually moving items forward?
I believe the answer is somewhere in the middle. You remain an advisory committee. Brandy is the controlling decision. You vote as an advisory committee under Brown Act rules. So your vote is duly noted. If Brandy chooses to go in a different direction, she is authorized to do so.
Okay, thank you.
But just for the record, we are reaching a point in time where we're moving past purely advisory status in terms of Brandy's, and I'm not going to just say Brandy, that would be inappropriate, the HR directors going along with the advisory committee, and it's something that needs to be addressed with respect to the conflict of interest code. I've done a draft previously, but typically advisory committees don't need to comply with conflict of interest code issues because they're purely advisory. But there's a gray area in the law where once you reach a point in time where you're really not advisory anymore because the final decision maker is always going along with those decisions, then a change needs to be made. And it's something I've looked into and hopefully we'll be addressing this year.
Fonse, does that answer your question?
Yes, it does. Thank you.
Okay, thank you. Is there any discussion needed regarding the quarterly minutes from February 4th of 2021? Any discussion needed regarding the minutes of the special meeting of March 18th of 2021? If no discussion is required, then we would be looking for an approval and a motion and a second.
This is Fonse. I make a motion to approve both set of minutes.
I second it.
Chrissy, was that you that gave us the second?
Yeah, but you can have Nancy do it. That's fine.
I did it too, so whatever. It doesn't matter.
Okay. Okay.
They're seconded and seconded again, right?
There we go. Okay, Donna, will you take the?
Yes. Jay Wilberding.
Yes.
Christine.
Yes.
Catherine Miller.
Yes.
Jeff.
Yes.
And Brandy.
Yes.
Thank you.
Thank you very much. Next on our agenda is public comment. So public comments are limited to 250 words or less, and they may be submitted by emailing SJCDCA, see public comments at sjgov.org. Every effort will be made to read all of the comments received into the record. Some comments may not be read due to time limitations. Comments received after an agenda item will be made part of the official record on file with the committee if received prior to the end of the meeting. Donna, do we have any public comment today?
We do not.
Seeing that we don't have any public comment today, we'll move on to our next agenda item, the program status report with Empower's Bob Gleason.
Thank you. Good morning again, everybody. I will share my screen here to pull up the first report. All right. As you all know, we had a recent change in ownership at the first of the year. Empower Retirement purchased MassMutual's retirement business. So we are now fully operational as Empower Retirement. Dan Morrison, our Senior Vice President and leader of our government market, joined the committee in January. He gave a brief overview of Empower. I just wanted to take a moment to touch on a couple of points, and then I'll get into the main or the typical reporting that you're accustomed to seeing. Just a few things about Empower. We are the #1 record keeper ranked by year-over-year asset growth. Assets under management, the slide says 884 billion. In fact, during the first quarter of this year, we actually surpassed $1 trillion in assets. So very proud of those markers, and looking forward to continuing to grow into the future with our clients. In terms of service model, we offer a fiduciary model that delivers advice to participants. Currently, under your program, we don't really have an advice component, but I just want to make the committee aware that Empower does offer advice offerings, and that's something that we'll talk more about into the future. As of now, there are no changes. It's the same program that's been in place for several years, but I just wanted to make you aware that there are other options available when it comes to delivering advice to plan participants, and we'll be happy to explore those with you in the coming months. Engaging participants with innovative and intuitive resources. I'm going to talk to you in a few minutes about something that was mentioned earlier in the year, which is Empower is going to be migrating the MassMutual business to its proprietary record-keeping platform. And along with that change, you'll get a more upgraded website experience, both from the plan sponsor perspective as well as from the participant perspective. There's just a few things that are highlighted on this slide. I won't go into any detail. I just want to, again, make the committee aware that changes are coming in the future, and we are excited about that. It is a very modernized platform, very responsive. It's a proprietary system, and we do have a guarantee in terms of protecting participant data. Essentially, if folks adhere to establishing an online presence and maintaining their passwords privately, not giving it out to others, we will protect their account against loss if it's due to outside theft or bad actors, trying to access an account to steal money. And then finally, the benefit of an empowered transition or migration. When we talk about switching record-keeping platforms, it won't be an experience like you went through 5 years or so ago when we moved from the Omni platform to the current Reflex platform. This is more of a migration where we kind of just lift the data and records on one system, and we shift them over to another platform and drop them in. From a workload standpoint, it's a much easier lift. On the left-hand side, you see some of the advantages of this type of a migration as compared to a traditional or conventional plan conversion. So by doing the migration this way, we retain investments and interest rate guarantees and in the full menu of investment choices, retain extensive plan and participant history and records. So the history will also transfer with the records on the record keeping system. Typically, this type of migration is shorter in term. So when we do go to migrate your plans, it will be over a weekend plus 1 day. So the slide says typically in a weekend, given the trust structure that you have in place, it's going to require 1 additional day. So whether that's a Friday before or a Monday after, it'll be a weekend plus 1 day where participants won't have access to their account. It'll remain fully invested. It just, people won't be able to access it or make transactions. And then lastly, the service team will remain the same. David, myself, Kurt O'Neill, and others that service the plan today will continue to service the plan after the transition. So why am I bringing all this up? It's because we have scheduled the county's plans to transition in January of 2022. We've got a series of events, we call them waves. So plans, all plans that are Mass Mutual will be transitioning to the Empower platform over the course of 8 wave events. And the county's plans are scheduled to move in what we call wave 4, which is scheduled for January of 2022. There was a lot of thought behind when a plan or a client would be put into a particular wave. And a lot of the logic behind moving the county's plans in January of 22 is also due to the fact that although this committee, I don't believe, has oversight over it, we also have a VEBA plan with the county where we record keep those assets. And that particular plan is on a different record keeping platform. It's still on the old Omni platform. So the county currently has 2 platforms that they're utilizing. Our Omni platform is going to be decommissioned first. And so all assets on the Omni platform are going to be moved by that January 2022 timeframe. So given the fact that that plan is moving, it was also thought for the best experience for the county that we would move all plans at once. That way, all 3 of your plans would be on one record keeping platform with Empower. Your relationship with Avabin, the third party administrator overseeing the VEBA will not change. That will still remain in effect. But we just wanted to move all the plans at one time. So the January 2022 time slot seemed to make the most sense. I'm mentioning all this to you now. It's early in the process. If for some reason you all feel that the timing for that is poor, given other things that are happening at the county, we have time to talk about that and potentially move the date back if needed. If not, our preference would be to move forward with the migration in January of 2022. Any questions about that before I move on with the report?
Bob, you mentioned advisory services. Now, is that a fee-based advisory service? Is that free?
Yeah, we offer one aspect is a managed account service, and that would be for a fee, and that would be at the participant level. So only those participants who would elect that service would pay that fee. It would not impact anyone who did not elect that service.
And then in regards to the data that's going to be moved over, How is that determined? Again, when we go into the Empower system right now, I can see about 4 years worth of data. Actually, I'm not sure how many years of data, about 4 or 5 years worth of data. How do we determine if we wanted 10 or 15 years worth of data to be brought over? I know that there were different custodians, but what actually went through at that time?
Yeah, all that we have actually is the data that's been on the system since it's been on the Reflex platform, which would go back approximately from this point in time, it'd be approximately, I want to say 4 years ago is when we moved it over. So we have about 4 years worth of data, and that would transfer over.
Thank you.
Mhm.
Bob, I have a couple questions. I'm really struggling with the new system. I made some allocation changes on February 17th, and I printed out the confirmation sheet that the changes had been made and saved. They weren't. I called again on April and worked through a long holding pattern through the number on Retire Smart because I did a rollover from my city Mass Mutual, and it stranded $1.12 in the fund. So I called to see if I could just get that moved over into my county deferred comp plan. Spoke to 4 different people, was transferred. Finally got someone who said, it's done. We've done it as of today. I just went in this morning. None of these changes have been done yet. I've lost out on a couple of months of really strong stock earnings in my plan. And I'm not quite sure how to fix it, but I know that if I'm struggling with this, other employees are also struggling with this. So what's the recommendation for, who do we talk to? How do we get through to folks to make sure this is done? Because twice I've been absolutely assured that it's been done and it hasn't.
Okay, well, first I apologize for that, Kathy. I'll ask David, he's on the call, to follow up with you directly.
That'd be great.
To get all the details, and he and I both will look into what happened, why it happened, and see if we can make things whole for you. As far as that small amount that was left over at the city, that does unfortunately happen sometimes. An account gets moved, and maybe there's a small dividend or something that gets paid after the fact, and it's left over, and then we have to move that over in a second move. I'm guessing that's what happened there, but I don't know.
It is, and I wasn't the least bit concerned about the $1.12.
Yeah.
But when I first called to resolve it, they said,
right.
"Oh, well, we'll cut the check to UBS and send it to you." And I'm like, that makes no sense at all that you would cut a check for $1.12, mail it to me, and then I have to mail it to UBS. That's ridiculous. So can you just move it into my active county account? I'm not kidding, Bob. It took 3 additional transfers to get that done, and it still hasn't been affected. So I understand how it happened, and I wasn't upset about that, but it shouldn't be that hard.
No, it shouldn't be. Yeah.
Work it out. And so I'm less concerned about the issues with myself and more concerned about what it says for what all our other employees are experiencing.
Yeah, no, I do apologize again for that. That's not a typical experience, but unfortunately it does happen from time to time, and it happened to you in this instance, which, again, I'm sorry to hear, but we will look into it and get it rectified. As far as how this relates to the migration and everything, the current platform that we are on we call it Reflex. It's the old Mass Mutual proprietary platform. And when you call in for service, you're also getting the Mass Mutual, the old Mass Mutual call center, so to speak. It's that same group of folks. Unfortunately, that group has dwindled over time, and it's not as fully staffed as it should be. So we're aware of the longer wait times, and they are being addressed. We are hiring people, we are getting them trained, and as Empower has a different view of call centers and how they should work. So one of the benefits, I guess, to the migration that I'm talking about is we're getting all of the plans on one platform, and you'll also be a part of the Empower call center, which historically has had, I think, a better track record in terms of response times and overall customer service. So we are trying to make that improvement, I guess. So I think you'll notice an improvement once everything is moved over. I should back up. You'll notice an improvement, I think, right away. Probably already now when you call in, the wait time shouldn't be like what you were experiencing, because I know we've already added staff and we're continuing to hire and add more staff to get up to what is considered the Empower standard in terms of call center staffing. So that takes a little bit of time, and we are working on that. But again, once we migrate everybody over to the Empower platform, everyone's going to be merged into the Empower call center, which I think you'll have a better experience overall. And to the previous slides, I talked, Fonse asked about advice. There's just some additional features, I guess, that Empower offers within their program that we'll be able to make available to the county.
Apologize, everyone. I actually need to leave for a 10:30 meeting. If I get off that call, I'll jump back on. But again, I have to leave for another meeting right now.
Okay.
Thank you.
Any other questions on the migration or transition before I move on? No. Okay, and now we'll get back more into the traditional slides that you're more accustomed to. The quarterly plan statistics, looking at a snapshot year-end numbers versus end of Q1. Ended the quarter at 510 million. So we went up about 13.8 million. If you look all the way down to the bottom of this, the last entry here is investment income. You'll see it's 16.7 million roughly. So assets went up by 13.8 while there was investment income of 16.7. So cash flow was roughly a negative 3 million over the course of that quarter. Outstanding loan balances started the quarter at 329,000, ended the quarter at 870,000. So there were some additional loans taken, obviously, over the course of the quarter. Contributions were relatively flat, 4.7 million, up just slightly from 4,708 to 4,749. Rollover contributions, these are incoming rollovers, 578,000, up from 219 in Q1. And then employer contributions, 223,000 for the quarter. In terms of withdrawals or distributions, withdrawals were down slightly from 1.8 down to 1.4, and terminations, these would be lump sum distributions, were up to 6.2 million. So we did experience a heavier month for rollovers out of the plan, which is what this report is showing. This was a heavier quarter. You can see on the bottom, rollovers out of the plan totaled 5.1 million. We had gotten it down to around 2.5 to 2.7 million. Last quarter, it spiked up to 5.1. There were a total of 8 transactions that I noticed that were over 200,000. The largest one, there was one for 984,000. that went to TD Ameritrade. This report is organized by the payee name, so that you can get a sense for where the dollars are transferring out to. TD Ameritrade in this case had several transactions that totaled about 1.5 million. That seems to be the largest area where folks are leaving to. Vanguard is another one on the bottom. You can see the transactions to Vanguard.
Hey, Bob, that sheet isn't showing up on the screen.
Oh, it's not.
No. If you're talking about the rollovers.
I
Yeah.
think you hit
Or is it there now?
the executive summary, is that
Okay.
is that what you're referring to?
Well, when he was talking about Vanguard, it was on the bottom, so I thought we may be talking about this. Maybe you're okay.
No, I actually I did on my screen. I switched to another report.
Yeah,
And
that
there-
report,
Yeah.
You're
only
not
the
seeing
executive-
that?
Nope.
Nope.
Let's see.
Bob, you may need to unshare and then share again with that document. That might be easier.
Yeah, thank you, Vincent.
Quarter one.
Can you see it now?
There we go.
Yes.
Yeah, okay. Sorry about
Thank
that.
you.
Thank you for pointing it out. I didn't realize. So this is the rollover out report I was speaking of, where you can see each transaction, somebody rolling money out of the plan and where it's going, the payee name. We have it sorted so it's in order of payee name, and then within each payee from high to low. The largest transaction I was pointing out, there was one person that transferred out, had nearly $1 million, 984,000. And there were several transactions to TD Ameritrade. Vanguard is also another popular one that people are selecting. This one was heavier than typical. Like I said, Q4, it was like 2.7 million. Q3 of last year, 2.6 in Q2. So this 5.1 is certainly a spike. We are doing all that we can and continue to do whatever we can. We'll look to you for ideas on how to reach out to folks. I know David's had some experience reaching out to retiree groups and trying to get the word out through them that keeping your money in the plan is a very viable option, and the reasons why. But we're always open to the committee's suggestions on how to reach folks in a better manner.
Well, what are these
This is
investment,
Fran. No,
Excuse
go
me?
ahead.
what are these investment companies offering that we're not? I mean, last quarter, it was mostly Charles Schwab. This time, well, I guess that one with 900,000 is the biggest one, but still, it's like, what are they offering? I'm assuming they're people that are moving out there guaranteed, because mostly these are retirees that are bailing. So what are they offering that we're not? And
It
I'm
could,
expecting the interest rate.
yeah, some folks, I mean, the Vanguards, TD Ameritrades, I mean, a lot of those folks are probably do-it-yourselfers that just want to have it on their own. Especially, if all they're doing is investing in Vanguard mutual funds, it might be a little bit less expensive to go direct to Vanguard. But others, Edward Jones, JP Morgan, Global Atlantic, LPL, those folks, a lot of these folks, they're going with an advisor, I'm assuming.
Yeah.
You know, they may have their money already, the money outside of deferred comp that they invest. They already have an advisor relationship,
Okay,
and then
I already
they're
have some.
consolidating with them. And that's one of the things I was alluding to earlier, that's one of the potentially added services that we can add as Empower in the coming months ahead. You know, post-migration might be an advisory type service. But again, that would be up to the committee if you wanted us to take that extra step. And we can certainly talk more about it when the time comes.
When I'm interacting with these individuals like this, some of them think they have to move the money. Someone is telling them it has to be done. They've walked into the bank and the bank cashier says, do you have any retirement accounts or something like that? And there's some misinformation that's sometimes given out. Sometimes they're already working with an advisor, and that advisor is waiting for this opportunity to say, hey, now that you've separated, you can move it over. Some of them, few, are they're focused on, oh, I'm looking for very specific investments, and now I have that opportunity to do that. And then a few are seeking annuities, or they're being told that they have to buy an annuity or something like that, or it's RMD time, and whomever is helping them with the RMD says, oh, you need to transfer all of it over here, or something along those lines. And it's just kind of falling into, well, you're already doing this event with this organization, we would like to help you with the rest of it, or something like that. But it is, for some of them, they're saying, oh boy, I want some rate or something, and someone encourages them to buy an annuity to lock in, okay, it'll grow at 3% for whatever, but you don't have the liquidity on the withdrawals or something like that. But for the ones that I interact with, usually it's conversations along those lines. And then for some, they are moving out of state or something, and I think we talked about this in January, and moving out of state is not a valid reason to take it out, but they think, well, I'm in Florida now, and I just want to feel closer and more connected to it, or something along those lines. The majority of the reasons, I'm a little biased in this. I think, no, it's more efficient to leave it here at the employer, but everyone has their own goals and objectives on what they're trying to do with this and how they feel comfortable with the money they saved over their career.
Thank you, David.
Good points, David. Any other
Bob?
comments or yes?
Yeah, this is Brandy. I have a question. So I noticed we track those individuals that are rolling out. Are there any statistics on new employees who are maybe transferring from their old employer to us?
Yeah, I'll go
The
back
roll-ins.
to the other report.
I guess that'd be a roll-in. I couldn't decide what it was called. I know Supervisor Miller mentioned moving her city to the counties.
Yeah,
I just wasn't sure.
this line item right here, rollovers. These are all incoming rollovers. So these would be current employees that are moving money into the plan. So last quarter, 578,411 came into the plan.
I speak with every meeting I have. That conversation comes up for new employee orientation. That topic is mentioned. I think last year about 40 individuals had outside monies that they moved in. I don't have the dollar amount total to that. Of course, some of those are false leads where someone thinks they have an account, but they don't, or something. But we're actively, on an individual level, communicating with people, and it is mentioned on their first.
I recall you mentioning it during new employee orientation when I attended.
Right. So, and a lot of times someone does it, or that pipeline starts, and that process takes a long time. People that enrolled in March, maybe, they probably, if I know I've talked to 5 people in March, none of them, their money has come over yet. It takes a good amount of time. And of course, the county, it's such a great marketing tool to say, hey, this is a huge employer. They're very focused on the investment. The expenses are probably cheaper than wherever you last came from. So all employees, when the stars align, they say, yes, of course, I want to do that. And our rollover team, when the pipeline comes through me, I'm able to navigate that very efficiently on, hey, Eric, talk to so-and-so, and have those funds transferred or however else.
I appreciate that. I will be honest, I have not rolled mine over for a variety of reasons. So I think I may have a slightly different perspective than you. But I wanted to see the dollar amount to compare to what was rolling out, so that's why I asked Bob the question.
Yeah, and you know, unfortunately, when folks are ready to retire, that's, you know, after they've been with the plan a number of years and they have the highest balances, and they're rolling their dollars out. That's why we're trying to, as best we can, get a handle on that, because we want to keep those folks in the plan. We want to keep them happy,
Right.
but we also recognize people have other reasons, other objectives, and so we have to be respectful of that too.
I can certainly try to push harder on rollover ins. In addition to my announcements that I'm putting out, we could attempt some kind of message. If you gotten an account, and more focus just on that conversation as opposed to the rest of the retirement related questions I handle. Well, I could push harder on that if the committee or HR feels maybe that's something we should focus on in the summer or the fall.
I was really just asking so that I could compare the two numbers every time we meet to see what was rolling out versus what was rolling in. Is it close to a wash? Is it not close to a wash? That was really the purpose of my question.
Okay. Then the next slide on the executive summary is showing participant counts. As of March 31, 6,298 participants. So we're up a net 49 participants from the previous quarter. Average account balances are continuing to go up. You know, the market is obviously helping that, but up over 80,000 now to $81,051. It's about almost a $1,600 increase from the previous quarter. Number of outstanding loans has grown from 21 at year end to 63 at March 31st. Percentage of the population with a loan is about 1%. Average loan balance, $13,816. Activity, calls the 800 number, and mobile app usage. Calls the 800 number pretty consistent. Mobile app usage is trending upwards. And then visits to the website had an upward trend also in the first quarter. Plan activity by investment. You can see the first one there is the guaranteed interest account. Started the quarter 172.9, almost 173 million. Ended the quarter at 172 million. Represents just under 34% of the plan's assets. Still the largest individual holding in the plan. Second largest holding would be your target date offerings, the T. Rowe Price series of funds. So collectively, if you added everything up, started the quarter at 16.5% of assets, ended the quarter at about 17% of assets. Overall, not a lot of changes to the portfolio, pretty stable. 401A plan, not quite as heavy of an allocation to the general account. You can see at the end of the quarter, about 18% was in the general account, which was down from just over 20 at the start of the quarter. Target date funds collectively also represent in this plan about 18.5% of the total plan assets. So target date funds would be the number one holding, just slightly ahead of the general account. Cash flow analysis, I'll just skip over this one. That gives you really just a visual picture of the numbers that we just went through in the executive summary. Asset allocation and investment balance. This is showing you by fund and by type of account holding where the money is. And then over here, investment selection percentage. That's showing you how future contributions are being allocated. So investment selection, about 20% of payroll allocations are being allocated to the general account as money is coming in. And collectively, your target date funds, if you added all those numbers together, it's about 51% of payroll is being allocated into a target date fund, which is, I think, positive going forward. That's a good diversifier, good diversified investment mix. And then participant average balances by age group. You can see the various age brackets on the top. Overall average account balance is 81,000. Your retirees, those that are age 60 and above, have just over 149,000 as an average account balance. And you can see going down the age brackets down to the under 30 crowd, average account balance is about 7,000. And then as you follow down each column, you can see how each age group is investing their assets. And you're seeing, I think, what you would expect and want to see. The younger age group, very little allocation, looks like about 7% allocated to stable value. The majority of it, or a good chunk of it, is in asset allocation life cycle funds, which would be your target date funds. So as people are getting older, their asset allocations are becoming more conservative. As you see that lighter blue bar increase with each age group, that's the holdings in the stable value area or the general account. More on diversification. Again, just simply pointing out that portfolio is pretty well diversified, or people are pretty well diversified. The first circle chart is showing you an illustration of the number of investment options held by participants. One option is the most common, 61%. But again, you have a very high usage of the target date offerings. So anyone that has one option that's in a target date fund, they have a very diversified portfolio. The second chart is showing you of the people that have one investment option, and that one investment option is not a target date fund, where are they putting their money? 89% of those that have one investment, not being a target date, it's in stable value or the general account. And then of that grouping, how old are they? That's this third circle chart. And of those that are only in the general account, you'll see that 79% of them are age 50 or above. So again, just an indicator of asset allocation. Participant interactions, just a more detailed breakdown as of 3/31 of, when people log into the website, what are they doing? They're checking on a statement of account, 35%. Looking up their account balance, 32%. Looking at the balance summary section, 9.9%. Balance transfers are about 7.7%. And, that allocation mix has been pretty common. The next slide, we always put the previous quarters in there, so you get a feel for it. It's the same top four categories, slightly different percentages, but people are continuing to mainly log in and just check on their account to see where their holdings are. Not so heavy as far as moving money around. And then lastly, I'll turn it over to David to spend a few minutes talking about his activities.
Thank you, Bob. So as you may be aware, my role here at the county is I educate the employees on how to use these accounts, what goals they should be thinking about, and just overall retirement education. And I am the local resource as well for employees that are calling in and asking questions or need help navigating something or anything like that. So in the past, I would be on site and I would be doing face-to-face meetings at the hospital or probation or wherever else. And last March, I transitioned to virtual due to COVID. So a lot of employees have adapted well to doing virtual meetings, but it is a different environment and it is challenging for some employees. I'm able to capture a whole new group that I never was able to interact with before, and I'm not interacting with some of the other ones that I'd see more often in the past. So in Q1, I had 23 days of individual meetings, and those 23 days where I had meetings and I'm sitting in front of the computer and another employee joins and we figure out whatever their retirement questions are going to be, 204 interactions total. That number for Q1, that is a little bit lower than historical, but this is our first Q1 of the year where it's 100% virtual. And also, I tried a couple different methods of announcing the meetings and marketing the meetings, and those don't seem as successful in Q1 as I had hoped. So I'm adjusting that for Q2 and 3 to try and promote the plan a little bit differently between having department contacts send out meetings and then working with ISD to make sure that something is going to be announced efficiently as well. In addition to those 23 days of meetings, I also had a lot of virtual group meetings where I would present on some kind of topic and talk about some kind of event. I tried to have what I've noticed so far is over the last year or two is a lot of people have market volatility questions. So I've been trying to have 1 or 2 market volatility presentations every month in addition to other topics. And while those attendance numbers were pretty good, it was, again, not as high as I was hoping, again, just because of the marketing in general. It didn't go in the way that I exactly wanted. So all said and done, 580 attendance for the first quarter, which is about standard. In the past prior years, we're seeing about 2,000 people a year. So I guess number-wise, it all's kind of even out, but it is less individual meetings than in the past. So I'm hoping in Q2 to just change my marketing approach a little bit. Meetings I did have in Q1 were people preparing to retire and just making sure their portfolios were set up for that stage in their life or questions on how to use this money once they do retire. Do I have any questions from the committee?
Are there any other questions?
Yeah, through the chair, this is Tammy. Hey, Bob, is there any place in this report, the quarterly report, that lists the total number of participants in the 401A plan?
Total number of? No, I don't believe it has number of. It's just the listing.
Of the
Is that something that could be added?
Yeah, we can add that going forward.
Okay, thank you.
Bob, do you have anything else for your for this particular agenda item?
No, I don't. Thank you very much.
Thank you. Before we move on to the next item, our Fonse rejoined, I believe I saw pop up about 10:53. Fonse, can you just confirm that?
Yes, I'm back.
Welcome back. Thank you. Okay. We are now moving on to the quarterly performance review for first quarter of 2021 from the highest group. Vincent?
Great. Thank you very much. Let me see. I'm hoping you all can see my screen. It's the San Joaquin County, March 31st, 2021 performance report?
We can only see you at the moment.
How
It looks
about
like
now?
There it is.
Yeah, I saw it.
Okay, probably much better visual. So this is the Q1 performance report. Again, thank you for the opportunity to present. As I go through this, I just want to lay down the foundation of what we're seeing in the markets, as well as the broader economy. Things certainly have improved, thanks in large part due to a tremendous amount of stimulus or financial relief coming out of Washington, D.C. But certainly the optimism is driven on the back of a huge rollout of COVID vaccines. And so there is some certainly light at the end of the tunnel from an economic standpoint. There are a lot of data points in my report, so I'm going to expand this or blow it up just because sometimes the numbers are fairly small in these reports. I'll skip over the narrative talking about inflation. With the optimism, we are seeing an uptick in prices. So if anybody wants to take a look at the challenges that the Federal Reserve or the Fed faces, you can read that on page 1 and some economic overview on page 2. But I'll touch upon just 2 leading economic indicators here. The first one in the upper left is the gross domestic product. And I talked about this. I just want to frame 2021 by talking a little bit about 2020. And basically, the gross domestic product is the measure of our economic output. It's the dollar value of all the goods and services produced in a country in any given year. And you can see that the short-term trend of this black line and the lightly dotted blue line is going in the right direction for the most part. You can see certainly with the pandemic and the shelter-in-place orders, with large chunks of the economy shut down, we did see a drop-off in GDP. The first quarter number came in at -5%. So the first time in 10 years, there was actually a contraction in the economy. But the pandemic fully was felt in the second quarter, and that number was -31.4. Congress and the administration acted, pumped a tremendous amount of relief through the system. The Federal Reserve kept rates low, and so we saw this snap back in Q3 where the GDP number was positive 33.4%, and then the fourth quarter of 2020 was 4.3%. The advanced number came out just recently for the first quarter at astonishing 6.4%. And again, that's driven in large part to the optimism around the financial stimulus, but certainly a back to normal regime with the rollout of the vaccine. So a nice first quarter number at about 6.5%. Not out of the woods yet. Certainly there's a lot more shelter-in-place orders locally here in the States as well as internationally, but knock on wood, we'll see. The second leading economic indicator that I want to briefly discuss is the unemployment rate. Historically, a measure of full employment is around 5 to 6%. We saw that dip to about 3.5% in the rosier parts of the economy. When the pandemic hit, we did see that spike to about 15%. It has since ticked back down. Nationally, the unemployment rate is 6%. There in the county is a little bit higher at 9%, but still a nice rebound in the unemployment rate or the jobless numbers. So good news there as well. Moving down into the next page, I want to touch briefly upon the yield curve because that typically drives bond market returns. I talked about the aggressive stance with the Federal Reserve or the Fed. They took a very deliberate act of keeping rates low on the short term, but went into the open market and bought bonds to try and keep rates low on the longer end of the yield curve. But with the significant amount of optimism, rates didn't stay low very long. And so you can see the yield curve, the lightly dotted green line is the yield curve from a year ago, and the solid line is the more recent yield curve. And rates have ticked up more recently on the longer end of the yield curve. And back in 2020, we saw rates drop, and the math with fixed income or bond securities, as rates drop, the value of existing bonds go up. and we saw a significant rally in 2020. The broad-based bond index, or the aggregate, was up over 7%. With rates ticking back up, we're seeing some short-term weakness in the bond market. So an absolute reversal from what we saw last year. So you can see for the quarter, 3.5% on the negative for the broad-based aggregate index. Year to date, as of yesterday, we have seen a little bit of improvement, still negative, but the ag, as of yesterday, negative 2.6% year to date. So a little bit of enhancement, but still negative nonetheless. Moving down on the TIP side, this stands for Treasury Inflation Protected Security. You can see 1.5% to the negative year to date. As of yesterday, that year to date is flat to positive. So a little bit of reversal on that TIPS index. And last but not least, you'll see the high yield or junk bond index. This is the more riskier side of the fixed income equation. And in a low interest rate environment, these riskier bonds are fairly attractive. You can see almost a 1% gain for the quarter in that junk bond index. As of yesterday, the high yield index is positive 1.9%. So a nice continuation on that more speculative grade fixed income marketplace. Certainly, as we're removing ourselves from the pandemic, the stock market has continued to rally, thanks in large part due to that optimism that I talked about. The S&P 500 on the upper right here had a phenomenal year. That's not a misprint. You can see 56% for the year, thanks in large part due to that 6.2% for the quarter. As of yesterday, that year-to-date number is now 12%. And then the Russell 2000, which is a small company index, up 100% last year. That year-to-date number of 12.7% is now 17% as of yesterday. So nice rally in the small company index. And then on the international side, we have seen some positive growth globally. The upper left here, you'll see the ACWI, or All Country World Index. This is about 45 countries outside the U.S. You can see 3.5% for the quarter. As of yesterday, 7.7% year to date on the ACWI. So nice recovery there. So I'll pause, see if anybody has questions, comments. All right. Hearing none, let me go ahead and drop that back down in terms of size. I want to pull up this page. There are a lot of data points that Bob mentioned, so I'll be brief. This is the broad overview of the investment menu for the 457 plan. The amount of assets within each fund, the percentage is how much of the overall plan each fund or asset class makes. These are not performance numbers. And you can see every investment option is ranked generally in risk order by asset class. And so you have the 5 fixed income funds, you have that guaranteed interest account, the 2 bond funds, this inflation protection or TIPS product, and then the TIAA-CREF high yield fund. You have funds that invest in large companies, mid-sized companies, and then those small companies that I talked about that generally track the Russell 2000. 2 funds that invest internationally, the target date funds, and then a dedicated real estate and precious metal. All in, total plan assets are just over $500 million as of the end of the quarter. And as I go through the report, let me expand that a little bit. You can see the cash flow characteristics, and again, I'll be brief because Bob did a good job about talking about all the money going into the plan, that's the cash flow positive. All the money leaving the plan through rollouts, distributions, terminations. You can see on the quarterly basis, the cash flow was net negative. Again, back to the point that David, Bob, and the rest of the committee were talking about, just trying to stem the rollouts or distributions or somehow figure out a way to bring up the contributions. But nonetheless, you can see that cash flow characteristics for the quarter as well as the last couple of years here. The average account balance, you can see, grew by about $2,200, ending the period at just over $81,000. And then from a plan standpoint, this discounts cash flow, but you can see On a weighted basis, the plan's investment grew by over 30% for the year, about 3.4% for the quarter. Moving into the 401A plan, similar page to the 457, obviously different allocation, different total plan balance, but this is exact same menu, and you can see the allocation spread over the 401A program. And then different dynamics from a cash flow standpoint. You have more money going in for the quarter, you're leaving, and the exact opposite than the 457. This plan has experienced positive cash flow for the quarter as well as the last couple of years. Heavy growth or high average account balance. This grew by over $7,000 for the period, ending the quarter just over $165,000. And then from a return standpoint, this plan returned over 40%. Pretty impressive.
Wow.
And I'll talk about some of the performance of the funds here in a minute. So I'll pause, see if anybody has questions, comments. Okay. So taking a look at this page, this is the somewhat intuitive overview of the underlying characteristics of all the investment options within the two plans. What we do is we take those characteristics of the investment options, screen them against the metrics in your investment policy statement. Hopefully there are no violations, everything passes, and that shows as a green P. If there's any violation, it will show as a red dot or fail. Currently, there's one and only one fund that's on watch. There has been a fund that has struggled from a performance standpoint, but also about a year ago, experienced significant manager change. American Beacon International Equity was placed on watch towards the end of last year. We discussed the three sub-advisors, Lazard, Causeway, and Franklin Templeton. Franklin Templeton was terminated by American Beacon and replaced with American Century. That represented a third of the portfolio, was significant enough to flag the red dot for violation. And like I said, has also suffered some short-term underperformance. And so our recommendation is to leave this plan, or excuse me, leave the fund on watch, but also leave it in the plan. There is another relatively new development, the Wells Fargo Special Mid-Cap Value Fund. Recently, Wells Fargo Asset Management decided to sell the asset management arm, not the entire banking structure, just the asset management or the mutual fund division, to two private equity funds. And this transaction will happen in the second half of this year. Despite, through regular conversations with Wells Fargo Asset Management, we have been instructed that these two private equity funds, which will own 90% of the company at the end of this year, nothing's going to change. They're not going to tinker or edit any of the strategy or personnel. We are, how do I say it, cautiously optimistic with a healthy dose of skepticism. We've seen fund companies been purchased by private equity firms before. Again, despite the assurances, our recommendation is to place this particular fund on watch, given the significant ownership change. And again, we'll be in regular contact and see if that positive outcome where the private equity firms do not tinker with what's been working okay in the past, or if they decide to make some changes, or quite frankly, if key personnel at Wells Fargo Asset Management decide to leave given the ownership change. So we'll stay on top of it, but our recommendation for now is to leave it in the plan, but place this particular fund on watch status. And really, those are the only two funds that are worthy of discussion now. Certainly, if anybody on the other end of this call has questions, please let me know. As we go through this section, this is the performance part of the section. Every fund on the menu is represented by a primary colored row. The performance of that fund is towards the middle over different time periods. Calendar year performance, net of fees, is more towards the right-hand side. Directly beneath the performance number is the performance of the appropriate benchmark or index as called out in your investment policy statement. The plus minus index is any out or underperformance. And then the grayed out row are peer group rankings expressed as percentiles. These numbers will always be from 1 to 100. And generally, we're looking for numbers closer to 1 as opposed to numbers closer to 100. Certainly, we're going to see some good long-term managers suffer some short-term weakness, especially in this market environment. And even though a high peer group ranking is not necessarily desirable, sometimes we understand why. And again, if nothing really has changed with the manager, we're willing to give them somewhat of a free pass. MetWest Total Return Bond manages a very conservative bond portfolio, and that's why we're seeing some short-term weakness here. And given this environment, no real long-term concerns. DFA, Inflation Protection Security, that TIPS product, same thing, suffering some short-term weakness, but given the conservative makeup in this junk bond market rally, we think it's understandable. Similar story with the other junk bond manager, Tia Kref. Moving into some other funds, and taking a look at some of these one-year numbers, absolutely phenomenal. T. Rowe Price large cap growth up almost 68% for the year. Wells Fargo, this is the fund, again, given the ownership change, we'd like to place this fund on watch. But this particular fund was overweight international markets, overweight cash. It did have some sector selection in the financial sector. It was overweight insurance companies and underweight banks, and that caused some of this underperformance here. But if you take a look, again, some good, solid long-term numbers. 70% for this mid-cap index, 60% for MFS mid-cap growth. Moving on, DFA target value over 113%. Given the recovery of the last 12 months, pretty astounding. And I'll pause to see if anybody has questions, but short of those two funds that are watch candidates, no real issues with the lineup. So I'll pause, see if anybody has any questions. And Brandy or Jason, if we were to put that Wells Fargo fund on watch, does that require a motion or is that automatic? I apologize for the question.
All right, bear with me, Vincent. I was looking for the mute button. I would recommend a vote. It's within the chair's discretion, of course, to make the decision, but if that is an action that the committee wishes to take, I'd recommend a vote.
Okay.
So, Vincent, is that your recommendation, that we go ahead and put it on the watch now?
Yes, with the announcement, yes.
Thank you. Is there anybody on the committee that would like to make a motion?
This
This
is
is
Fonse.
Jay. I'll make the motion.
This is Fonse. I'll second.
Yes, I think we had Jay and then Fonse. Did I get that correct?
Yes, ma'am.
Thank you.
Ready?
Yep, Donna's
Okay.
going to take the vote count.
Christine Batt,
Yes.
Nancy Coffey. Nancy. Do we have any chat come in?
I haven't seen a chat come in for Nancy.
Nancy, are you with us?
Let's move down.
Okay. Catherine Miller,
Yes.
Jeff Wilkamp,
Yes.
and Brandy.
Yes.
And let's go back and see if Nancy has joined us.
And Tammy doesn't have a, nope, there's a text from her.
Okay. Thank you.
Hey, thank you, everybody. Vincent, anything else on this item, the quarterly performance review?
Of course, just very briefly, I want to touch upon the fees, just outline the underlying economics, only because it's a fiduciary responsibility, and I just want to explain it in the waning seconds of this report. Essentially, all the fees that are being charged and an accounting of that on an annualized basis with quarterly numbers, all the investment options, this is the 457 plan, all the investment options here, the expense ratio in this middle column, and then the administrative tack-on fee of 9 basis points, and then the accounting is such that through multiplication by these percentages in the assets, participants are paying roughly $1.8, $1.9 million a year to invest in the plan, and the admin credit is about $459,000. Mass Mutual collects their contracted revenue of about $290,000, leaving about $171,000 for plan-related expenses in this particular plan, and then about $7,000 in the 401A. It's just the same data, and so I just want to highlight that our responsibility, meaning highest group's responsibility, is making sure all the economics are still reasonable, and that's what this is intended to do. Our opinion is that fees are still reasonable on the investment side as well as the plan administration side. So unless there's questions on this particular report, yes, that concludes this particular item.
Any questions for Vincent? And we'll move on to our next agenda item, which is the highest group again for the annual investment policy statement review.
Okay. Let's see. Okay, I'm hoping that on your screen is the investment policy statement.
It is, thank you.
Okay, great. So a little bit of background on the investment policy statement. Essentially, the investment policy statement is a roadmap or guidebook for the ongoing selection, monitoring, watch, termination of the investment options within the two plans. Our job as a co-fiduciary is to not only follow it, but to, on a regular basis, come to you with proposed edits, things that we see that's reflected in the industry or best practice. And as you can see, it's been a year since we last updated it, and this is an agenda item that we propose our edits and that you can discuss, adopt, or not our proposed changes. The bulk of them are merely administrative. As I go through this, you can see obviously the cover has a different month and year. Let me see. Skipped over some. Okay, the first one here. Yes, here on the bottom of page 5. Essentially, what we do is describe the allocation of some of these target date models. You can see the industry has moved from 30% to 50% of equities of the total portfolio of the 2015 to 2020 vintage. And so in an effort to comport more closely with what we're seeing in the investment landscape, we're proposing changing the 30% to 50%. The next change, because the plans added the 2065 vintage towards the end of last year, we're proposing adding that to the investment policy statement, so simply tacking that on in this description here. The other change is adding the peer group, the intermediate core bond, in addition to the immediate core plus bond. More administrative, but I think it reflects how we're reporting more closely. And that concludes the more administrative changes. This one might get a little bit weightier, but it's fairly straightforward, but I'm happy to answer any questions about the previous ones or this one. There was a case not too long ago where there were a number of funds or vintages within an entire target date portfolio. So back to the point with San Joaquin County, There's the retirement income or balanced all the way down to 2065, and then years in between. In this particular case with another client, 2 and only 2 of the vintages were underperforming and then showing red, and it created this interesting, I wouldn't say awkward, but fairly interesting conversation around if only a handful of the entire suite of target date funds were underperforming, do we place just those 2 on watch? And what happens? Do we replace just those 2 with another provider? And so after internal discussions, we decided to make this proposed change to investment policy statements that says the individual funds within a suite are going to be treated as a whole if more than half are violating the metrics. And so if you take a look at this language, we're basically saying we're removing the one-offs where 1, 2, or maybe 3 funds are violating. Not that we wouldn't do some more due diligence on our end or talk to the fund manager to try and understand why they're underperforming. This is merely from a watch standpoint or action standpoint with the committee here, is the trigger is it has to be more than 1/2 of the funds to be in violation. And then at that point, you will put all the funds on watch. And then last but not least, and I'll be quiet, you can see this last sentence here. It always gives you the discretion, whether it be the committee or the HR director, to do any action which you feel is prudent or reasonable to do so. And those are all the changes that we're proposing.
Vincent, this is Tammy. I do have an additional change. The verb on page 3, the verbiage was changed on advisory committee members, and so I can provide you with that information. It was the assistant county administrator that was changed. So I'll get that verbiage to you.
Thank you. Okay.
Are there any questions for Vincent?
Vincent, this is Jason, not a question so much as a recommendation. In that language that you added, ultimately at this point in time, the advisory committee doesn't have the authority to make any elections. I would replace advisory committee with plan. I think that's more consistent with the entire document.
So Jason, the plan may elect to deviate, is that?
Correct, because, well, or the director, I suppose. I did see the change. That was my concern. I would need to make sure that we're consistent throughout the document. But ultimately, the decision maker is the person electing to deviate if it appears reasonable to do so. The advisory committee isn't the decision maker.
Great point. Okay.
This is Fonse. I had some minor comments just for consistency purposes on that document. I provided it to Tammy, so it's up to you, to you guys if you guys want to incorporate those items.
Yes, and I was going to, thank you, Fonse. This is Tammy. I was going to send that along with mine to Vincent because they were not, they were just more words like participant and that. Was there anything else that you wanted to specifically bring to the committee's attention?
Yeah, just the rating agency. I know a few years ago we had to change the wording on that to what was it? NRSRO. So I just kind of updated the item on page 6. Credit rating agencies such as Moody, S&P, or Duffy and Phelps. I just recommended to make an edit to that to just say at least one nationally recognized statistically rating organization. I think that wording might be better than to actually name out the rating agencies, just in case they're not there the next time we look at it.
Yeah. And if we don't want to use them.
Correct.
And Tammy, you have all these changes, correct?
I do.
Okay.
Any other questions for Vincent? And we will move on to our next agenda item, the status of the empowered guarantee interest rate. Tammy will present that.
So just as a recap, the administrative agreement with MassMutual / Empower terminates on May 6th of 2021. after 5 years of being in the agreement. So we went to the board, as I mentioned last time, there was indication in a board letter 5 years ago that there was automatic extensions for additional 5 years, that when we pulled the agreement and we pulled the RFP, that language was not in either document. So we went to the board to extend the extension to the agreement for Mass Mutual and Empower for an additional almost year to April 30th, 2022. Also, as part of that process, the investment agreement has a 1-year termination clause. So the county notified Mass Mutual and Empower of the intent to terminate as of 4/30/22. So during this next year, the guaranteed account, we got in writing, and it's been approved by the board that we are going to earn a 2.15% interest rate, and then allow the county to continue to make deposits into the guaranteed account. Currently, that's at 2.3%, but the contract states a minimum of 1%, so it is better than the minimum as stated in the original agreement. So I just wanted to bring the committee up to speed on where we were at on that process.
Are there any questions or comments for Tammy? Okay, then we'll move on to our final item. Is there any other business that any committee member would like to share? So as individuals were joining, our CAO did ask if there was potential to meet in person. We will see what options we have for rooms that can also do the YouTube feed for us and report back to the team before the next meeting. And we will check to see if there's any other final public comment.
No additional public comment, and then no public.
There is no public comment, so we will conclude the meeting. Our next meeting is Thursday, July 9th at 10 a.m., location to be determined, and today's meeting is ending at 11:31 a.m. Thank you, everybody. Have a great day.
Bye, everyone.
Thank you.
Thanks, everyone.
Thank you.
Bye. Thanks, Paul.
Bye-bye.